And clearly the big story overnight was Mario Draghi's comments, but that really failed to impress the markets. The ECB chief extended the monetary stimulus, but it was way short of expectations. It extended the stimulus from September 2016 to March 2017, but the size of the monthly asset purchase has been left unchanged. Draghi did add to the range of assets that would be brought under the current program and also cut interest rates to spur credit. But the inflation outlook, which was the focal point of concern, was only changed slightly. European markets had priced in and added stimulus to near certainty in this run-up, and they faced a rude shock when Draghi took the podium.
We have a menu of options. Fortunately, our monetary policy has many tools. Our asset purchase program is flexible. We can always adjust its horizon, its size, its design, and we are not going to be, I would say, hampered in doing this by technical issues. As a matter of fact, we are going to revisit or review some of the technical parameters of our program in the spring. This time we decided that the extension of the horizon and especially the introduction of the reinvestment would be the right thing to do. And the new calibration that was achieved after that would tell that we would be able, we are confident to reach our objectives within the horizon as we planned. Which means basically we are not excluding the use of all other instruments if we were to decide that they were the right ones to do. I said before that the cut we decided today is adequate.
Okay, let's delve into those statements made by Mario Draghi and what exactly is the implication. We've got Tanveer Gill joining in. And Tanveer, highlight for us what this means for risky assets in emerging markets as well as for India.
For India and emerging markets, the excitement with regards to this ECB meet was hinging on the hope that if the QE program was expanded from 60 billion euros monthly asset purchases to 75 billion euros, that means more money coming into the Eurozone economy, thereby more allocations to EM assets, risky assets, equities perhaps, and that would provide some more upside to the region, and an increased allocation would come to India as well. However, there has been no meaningful disappointment in the policy statement so far. Yes, they haven't expanded the monthly asset purchases, but they have extended the timeline to end 2017 and perhaps beyond, looking at the data and the development over the course of time. In fact, the ECB's commitment to stay accommodative is something the markets would latch on to in due course. So what we might see tomorrow or in the near term is a knee-jerk reaction perhaps to the disappointment on that front that the monthly asset program has not been expanded, which would have fueled emerging markets and India, like I said, from a short-term perspective. But really, the long-term impact is a no-show because this is more related to the Eurozone economy and to help create growth there.
Testifying before the Congress's Joint Economic Committee, Federal Chair Janet Yellen warned that a delay in hiking rates could cause recession. In a bid to prepare the market for a rate hike later this month, Yellen reiterated that the subsequent pace and quantum of rate hike will be slow and gradual, and that the central bank's policy will remain accommodative. Yellen said her confidence has been boosted with that inflation will return to the Fed's target once the effects of oil and imports ease.
I currently judge that U.S. economic growth is likely to be sufficient over the next year or two to result in further improvement in the labor market. Ongoing gains in the labor market, coupled with my judgment that long-term inflationary expectations remain reasonably well anchored, serve to bolster my confidence in a return of inflation to 2% as the disinflationary effects of declines in energy and import prices wane. We must also take into account the well-documented lags in the effect of monetary policy. Were the FOMC to delay the start of policy normalization for too long, we would likely end up having to tighten policy relatively abruptly to keep the economy from significantly overshooting both of our goals. Such an abrupt tightening would risk disrupting financial markets and perhaps even inadvertently push the economy into a recession. Moreover, holding the federal funds rate at its current level for too long could also encourage excessive risk-taking and thus undermine financial stability. On balance, economic and financial information received since our October meeting has been consistent with our expectation of continued improvement in the labor market.
Find us on Facebook at facebook.com/ETNow and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.